This is your daily real estate syndication show. I'm your host, Whitney Sewell. Today, we've packed a number of shows together to give you some highlights. I know you're going to enjoy the show. Thank you for being with us today. Well, today I'm going to continue my conversation with Kevin Bupp. He is the founder and CEO of Sunrise Capital Investors, which invest in mobile home parks, parking lots, apartments, offices, and single-family homes across the U.S. He shares his expertise through the Mobile Home Academy and also as a host of the Real Estate Investing for Cash Flow podcast, which has become one of the hottest real estate podcasts on iTunes. Speak to the reason to move, say, to parking and what that asset class is like. We haven't talked about parking on the show too many times, maybe once or twice, less than a handful, 1,400 interviews. So why parking? What does that asset class look like? Maybe give us some of the pros and cons.
Yeah, no, absolutely. That's a great question. And, we've always liked to stay in our lane, stay focused. You can't be everything to everybody, and it kind of scares me sometimes when you got guys out there or gals out there that we're buying self-storage, and then we're buying mobile home parks, and we're buying multifamily. And then, we're also started buying medical office or whatever. They're kind of spread out amongst many different asset classes. There's a lot of carryover and similarities to each of these commercial asset classes, but there's also a lot of unique nuances as well with each individual one. And so we've always liked to stay in our lane and just really focus on being the best that we can in the manufactured housing space. In addition to that, unlike traditional multifamily, there's not many professional property management companies in the manufactured housing space. So we don't necessarily have the luxury of relying on a third-party professional management to oversee our day-to-day operations of our assets. And so we're vertically integrated on that side, which is it's a necessary evil. It's the unsexy part of the business. It's staff heavy and it's not very profitable. Again, it's a necessary evil in order for us to run the investment side of the company. And so when we came across parking, I was introduced to it, about 4 years ago. I interviewed a guy on my podcast. And again, I literally had never met anyone in my life that owned a parking lot or a parking garage. I knew someone owned them, but just one of those asset classes you just never really think about. You never dig into too much. And I was intrigued by the business model. One of the biggest things I was intrigued about is that, across the country, there are hundreds of professional operators. There's local, regional, and national operators, many publicly traded operators. But most of these operators, the majority of these operators, these multi-million-dollar companies, they actually don't own the parking. They're just on the management side of the business. And what I found as we dug in deeper was that we thought mobile home parks were fragmented 10 years ago as far as the ownership structure. Parking lots were equal, if not more, fragmented as far as who owned them. There's a few institutions in the space. If you go to Manhattan or you go downtown Chicago, there's going to be private equity institutions that own some of those parking garages, the parking towers, and things of that nature. But generally speaking, most of the parking lots, like surface parking lots, and even a lot of the garages are owned by just normal investors, mom and pops, or just small time investors that are local to that marketplace. And in addition to that, a lot of those small mom and pops haven't yet adopted a lot of technology. There's still many parking lots you can go to in this country, and you probably can't use a credit card. Either they got a parking lot attendant taking cash, or they've got even those old honor boxes. If you guys have ever seen those metal boxes where you shove your dollar bills in, that's dollar signs to us, because that means inefficiencies in a big way. That and even a physical parking lot attendant means major, major inefficiencies to us. And so we saw parking as an opportunity to buy an asset, knowing that we could rely upon a third-party professional operator that's got technology, they've got the infrastructure to take over the day-to-day, kind of like what you do in multifamily, and not necessarily have to build out that side of our business. We didn't have to necessarily build out a vertical property management or operations company for the parking business. So it allowed us to actually enter into a new asset class. It has a lot of similarities to that of mobile home parks. Basically, we're selling parking. We sell parking in mobile home parks as well, but without having to add additional staff to do that. In addition, we're able to pick up assets in great marketplaces, irreplaceable locations that make sense today as a cash flow covered land play. And we're not developers, we're not speculators. So anything we buy, it's got to make sense today as a parking lot, but inevitably its lowest use is of its present state. So if we're talking about a surface parking lot, it literally would be never worth anything less than what it is today as a piece of asphalt or gravel with cars parking on it. And so there's huge future upside as these local markets grow and, as these surface lots go away and they go away for vertical developments to take place. And so again, we just saw it as an opportunity to get into a new sector, get great assets in great locations, but not necessarily have to hire a lot of additional staff within the company to actually grow that side of the business. So
No, it's awesome. I appreciate just the detail around the parking type business and that asset class. Because like I said, we've not talked to too many people on the show that owns them, right? Like you said, it's just not as known. It's still fragmented. I love how you talked about, it's something that you could see, hey, we don't have to hire a bunch of people to get into this asset class. And maybe you did some research and you said that there were really good third-party management companies that are doing parking. And so you knew you could utilize them. Is that accurate?
Yeah, absolutely. And I'll give you an example of a recent deal we did. And so we've done some small deals and we've done some fairly large deals. And I'm gonna share the most recent one. It's a $34 million deal. Wow. And I just it shows you the inefficiencies in this space and where their opportunity that lies. So this one is a 7-story, 702 stall parking garage with 12,000 square feet of retail on the first floor. It's in Clearwater Beach, so it's in my backyard here in Florida. It was only built 6 years ago. So it was a private-public partnership on Clearwater Beach. And so there was a private local developer. They're mostly retail guys. And basically the city, put out an RFP. And, they wanted to build this parking deck in the North Beach area of Clearwater Beach. And this local developer got the contract. And ultimately what occurred is the local developer they condoized this entire thing. So they condoized every floor. The private developer ended up owning the first floor retail, and then the first, second, and seventh floor of parking. I don't know how they arrived at that, but first, second, seventh floor parking. And then the city owned the third, fourth, fifth, and sixth floors of parking. And, when they got into the endeavor, there was a pro forma put forth to the city of like, this is what your investment of whatever, their investment was like $12 million. This is what your return's going to look like. And ultimately, what played out in that scenario was, the private developer got the first 2 floors, which in normal times, not just like, 4th of July weekends, in normal times, they're going to get the proportionate share of the revenue. So they did a really good job negotiating this with the city, and they got the better side of the table there. It never met the city's pro forma at all for the 5 plus years that they've owned it. It sucked wind. It just did horrific because I'm not going to go into detail on the many reasons, but like the city was not happy with their investment. They wanted to take that money and redeploy it somewhere else. We ultimately met with both parties. We knew the private developer had considered selling it. It was a really hairy transaction, but we spent about a little over a year actually pulling both parties together. We bought both parts of the condo. And so now we own the entirety of the structure. And before we went down that path, we met with a lot of local operators because the operator that was in that garage, for whatever reason, the city went with a group out of Atlanta. Literally everything they managed was in Atlanta. They literally managed nothing in Florida. They didn't have any local market expertise. Anyway, they weren't doing a great job. Very inefficient, old equipment. They had put some antiquated equipment in there. It didn't work half the time. The parking rates they were charging were literally $3 an hour when they should have been $6 an hour. They weren't changing pricing for really high demand peak times. And so just a lot of inefficiencies in their model. So we saw that as an opportunity. We went to a couple local operators, put an RFP while we were in negotiations on this entirety of the structure, and basically got a local operator that manages about 45 assets down on the beaches. They've been in the space for a long time, and negotiate triple net lease with them on the entirety of the parking deck, and ultimately had that in place before we closed the property. So we bought that $34 million, which in place NOI was roughly a 6 cap. What's actually really good because it's an institutional grade asset. So we got at a really fair price going in. Lots of headaches to get there. But with this new triple net lease in place, this new operator knew that they were going to raise rates. They were going to implement some dynamic pricing models and basically get peak rates when it's peak demand times and lower the rates when it's lower demand times. I mean, they were going to maximize the efficiency of this garage. And so we just got a recent appraisal done on this garage. And I'm just going to say, I'm not going to give the exact, but it's in the low 40 millions. And so we added almost nearly $10 million of sweat equity just by literally just the value add plan was simply finding a better operator. I mean, literally finding a better operator that actually knew how to maximize the inefficiencies of that garage. And again, this is the institutional grade asset. But the cities, they're not smart. They should not be in the business of owning real estate. They made bad decisions. They priced it wrong. They wanted to give away parking for free. They should have been charging more. They would have got the return they wanted. They just charged normal market rates. They didn't. The private developer was sick of being in a partnership with the city. They were basically keeping their ability to raise revenues down. So the private developer couldn't raise the prices because the city had to agree to raise the prices. And it was just it was a messy endeavor. And I saw opportunity with those frustrations, right? And ultimately we pulled together. And so there's a lot of deals out there like that. And the thing is that there weren't other people charging for this deal. I mean, we literally didn't we had a little bit of competition, but it wasn't like what you and I experienced in the multifamily or the manufactured housing space. We weren't up against 10 other people to buy this property. And so that's the beautiful part of parking as well. There's not nearly as much competition to buy these assets.
Love that. You said so many great things about that deal. I appreciate the example, but something else that stood out, you said it took a year to close on this. Sounds like there had to be somebody that was willing to go through that process of a year, right? And then going back and forth, I'm sure with the city and the developer and kind of being the middleman a little bit. I'm sure there were many frustrations there, but somebody had to be willing to do that.
Yeah, it ended up being a little bit messier than what I had laid out there, but that's for another show. But we had to take some risks. We closed on a portion of the garage. We bought the private portion, and we closed on that about 6 months before. So we took some risks by doing that, but we knew that we knew that what that part was, that was the better piece of this garage anyway. And so worst case scenario, it still would have been a phenomenal return. It would have been a great investment. Not as good as owning the entirety of the structure, but it still would have been a phenomenal investment. And basically, we bought the private portion and we made the city's life hell for about 6 months is what we did by being in there and just doing things a little differently than what the prior owners had done, and forced their hand a little bit to move a little quicker to sell their piece of it.
Yeah, no, appreciate the color. Yeah, as well. It's definitely not an easy business, or everybody would do it, right?
That's fun. That's fun.
And I wanted you to speak to, before we shift gears a little bit, how did you find a good property manager for parking? Like, that's not something we've probably ever talked about on the show.
Yeah.
Speak to that.
Yeah, no, I mean, I think simply put, just literally go whatever respective market we're talking about, literally just go drive around and you'll find very quickly who the operators are in that area. You'll see their signs. I mean, most parking, if they've got a credit card machine or some type of pay station, it's going to be branded with the parking operator that manages that particular lot or garage. In addition to that, they pretty much all of them have signage with phone numbers in case you have an issue with like getting your car out or there's some type of incident that happens there. So one way or another, most of it happens by just simply driving around, or you can get on Google Earth. And now with technology, even the most antiquated parking companies at least can be found on like Google Places. So you'll be able to find, who actually manages this particular lot. And so that's it. There's really no rocket science to it. Who's the best, or, not necessarily who manages the most in a particular market's not necessarily the best. And so, what we have found in an area like a Tampa or any decent size MSA is going to have at a minimum probably 4 or 5 fairly prominent operators. And so it gives you a good selection to choose from.
All right, Kevin, I want to shift gears a little bit. Yeah. I want to go back to, if you're willing to relive it a little bit. I almost don't want to ask you to, but obviously the 2008, the crash, all that stuff that happened then, and maybe you could elaborate a little bit on, even how that affected you, your business. Obviously, I'm sure that's some rough times. You called it 3 years of, what was it? Damage control, I think you said.
It was damage control.
And so obviously very hard stuff, but you didn't quit there, right? You didn't just say, hey, you know what? I'm going back to the JOB route. I'm out of this real estate thing. You didn't do that. And I think a lot of people probably did, right? Never really recovered, probably mentally, just from the loss, right? And recovered and were able to keep going in this space. But you did, thankfully. Can you speak to that a little bit? Maybe what happened? But then I'd love to compare, hey, what's happening right now compared to then? What do you, because you lived through that, you were investing then, and I'd love to hear your thoughts.
Yeah, no, it absolutely was. It was a challenging time. You looking back, about the only thing I would have done differently is I would have, and I didn't stick my head in the sand, but I gave real estate a break, and I started a few side businesses that were. So I got into running. I literally met my now wife. I met her about 3 months before this major default happened. So it's kind of interesting timing. Yeah, interesting timing to say the least. And I met her, and I knew that things weren't going all that great. And I remember having the conversation with her one day. We were riding at a place down the beach, and we were riding our bikes, and things were going well together. And I'm like, I really like this girl. Like, I'm having a lot of fun with her, but like, I don't want to lead her astray down this path and think that she's got this waterfront property. And I knew things were going to get fairly ugly. And so I just laid it out and I said, I think it's going to be a bumpy road over the next 6 to 12 months. She was in commercial banking. So but I still don't think she really understood the breadth of it. I really don't, but she stuck by my side. And, anyway, so we're still together today. We're stronger because of it. And
sure.
But in any event, the one thing that I would have done differently probably was start buying sooner. it's really hard to get yourself out of a bubble. Like when you're in the bubble. So like I had a lot of friends as well that lost a lot of money during that period of time. And Florida was kind of one of the ground zeros. Arizona, Las Vegas, California, there was a number of markets that just got hit harder than a lot of other markets, right? And so Florida was one of those. I mean, the state of Florida was just decimated. And so it was really hard for me to step back and actually get an outsider's perspective. I was just too far ingrained in this local bubble or this Florida bubble, and that's all I heard was negative everywhere. And it was really hard to see the forest through the trees, and all the while there was opportunities left and right. But to me, the sky was still falling, and I didn't know it was going to stop falling, right? And so I would have started buying sooner, because I feel like we missed a couple of years of good opportunities or run up to where we are today. And so. But I started a few side businesses during that period of time that were related to health and fitness. I was a big runner at that point. My wife was a runner, or my girlfriend at the time was a runner, and I really, the one thing I could control in my life was how I felt. I mean, every day I woke up, first thing on my mind was who's going to knock my door today? What am I going to get served with? And just lots of challenges there, but. I didn't have, there's nothing I could do to fix that more than what I was doing. But the one thing that I could have complete and absolute control over was my body and how I felt every day, what I put into it, the fuel I put into it, and just, the mental clarity that I needed to kind of push through those times. So I chose to start a business related to health and fitness, and it allowed me to be around other people that were not real estate related, that were really focused on their body and their performance and things of that nature. And I look back and that was probably one of the best decisions that I made, because it really put me in a completely different mind state. I think it allowed me to stay healthy, mentally healthy with my relationship with my now wife at the time. Because if all I talked about on a daily basis was how bad things were and, oh, the real estate's horrible and I got bad credit now and I have no money, this, that, and the other, I'm pretty sure that she would have moved on and found someone else. And so, it's just, as far as getting through it, I think that's really what carried me through, is just really focusing on myself and just making myself be the best person I could be for not just me, but also for her. And I didn't have kids at that point in time, but I knew I wanted to go down that path at some point. And in any event, it took about 3 years of that to really get through the other side, I would say.
Yeah. It's a couple things there. You said, you focus on what you could control, and it goes back to, the mindset, right? And who you're surrounding yourself with. You talked about, you're surrounding yourself with people who weren't just negative all the time, right? Weren't in the real estate business. They were focusing on improving themselves and all that. I'm sure that was so helpful, no doubt about it. But then you got back into real estate, and was that something? Maybe your wife then was like, oh, wait a minute, Kevin. We've already done that thing. We're focusing on something else. How did you all stay on the same page and move forward back into this space again?
Yeah, that's a great question, because honestly, she made a move on from commercial real estate. So she had worked for a number of banks. She did mostly lent on hospitality and retail, and obviously both those got absolutely crushed as well in 2008. And the bank she had been with was taken over by the FDIC, I think about a year after we started dating. And so she was kind of fed up with having all of her calls with her clients became negative. I mean, basically calling loans due, and it just. They weren't fun conversations. They weren't, hey, we're ready to make you a new loan for this new project you have going on. And so, she made a switch in her career to get into a different career path entirely. And, at the end of the day, it's interesting because she's always been supportive, even with, I had to come up with a way to make money, after things started crashing. I had to figure out a way to actually put food on the table and to just, make it by month. And I never had a real job. And so, I would like to say that it wasn't funny back then, but I really wasn't employable. I'd never really had a true W-2 job. And so I wouldn't have known where to go at that point, because it would have, in my mind, it would have had to have been real estate related, because that was all my expertise. And so in real estate at that point, no one was hiring. So, she was always just very supportive of any idea I had, any entrepreneurial idea I had. Again, this is me trying to grind and fight my way through for these 3 years and find a business that actually could make reoccurring revenue month in, month out. And she never shot me down on any of those. Some of them were kind of harebrained ideas, right? But she never shot me down. And so when it came time to really talk about getting back into real estate, I mean, I kind of laid out a plan of, here's how I'm going to get here. Here's how I'm going to get there. I didn't have good credit time, but here's how I think we can work our way around that and actually get creative with financing, this, that, and the other. And she was on board. She just never pushed back. She's always believed in me, and I knew even before that point in time that just her being supportive during, these kind of dark moments, like that she was the one, like she was the right person. I got really lucky and found that needle in the haystack. And so she's just always been there for me, no matter how crazy the idea was. And that's what entrepreneurs do. They come up with just sometimes harebrained ideas, but you just got to roll with it. If you've got someone a loved one in your family that it's like crazy Uncle Kevin, right? Like, just you got to roll with it, because sooner or later that one of those ideas, it's going to be the $1 million idea. So you got to be supportive of them. And that's just their brains are wired a little bit differently. Our brains are wired just a little bit differently than a lot of others. And so, but I didn't get any pushback, Whitney, as far as getting back into it. She was, mobile home parks. She was kind of, she didn't really understand that so much, like that definitely we had a lot of dinner conversations related to this mobile home park. And she never would go up and she had never even saw that property until roughly probably a few months before we actually sold it. So we owned it for almost 10 years and she had actually never even seen it. Thank God she didn't, because she would have probably been like, what the heck are you doing? Because we took it over. It was completely vacant, had vagrants living in it, graffiti. I mean, like it was in rough shape, had been an REO for like 2 years. And so, but she questioned mobile home parks because everyone has that. Everyone kind of lumps mobile home parks in that one bucket of like, they're just wrong side of the tracks, bad elements, right, bad people in them. That's not the case. And so, but she was supportive and we pushed through. And once I proved to her financially the success of that one, no questions asked anymore. It was just like, hey, go do your thing. Buy more of those. If that's what makes you happy and that's what makes money, go do more of that.
But I'd love to, use our last few minutes too, just to get your thoughts on, what's happening now. You went through that recession, then obviously very tough time. But everything that's happening right now in our economy, the Treasury interest rates going up. Mm-hmm. How do you see all that? What are you focusing on? Are you, from what you learned, are you doing things differently now? What does that look like?
We've always, I feel like, even back then, I felt like I was a fairly conservative investor. That period of time turned me into an even more conservative investor. In fact, it probably so much that over these last 7, 8, 9, 10 years of a run up, I probably have actually passed on an opportunity that would have turned out quite well. Just from too much of a conservative approach of I guess having scars from going through. I don't want to rebuild it again. I don't want to go through that again. And I'm only 43, so I guess I have time, but I just rather not. I'd rather just be conservative and buy what I know makes sense and will absolutely not necessarily be a home run. You can't hit home runs every time, but I want to be hitting doubles and triples, and I'm okay waiting to buy the right assets. And so I think nothing's necessarily changed with our business today. I would say that we're buying less, only because again, now I'm looking at the shifts in the market and the rates. If you tie up a property today, there's a really good chance by the time your DD runs out and you have to actually let your money go hard if you haven't done it already. I know a lot of the multifamily deals that you guys are having to put money hard up front. But let's assume that just like you put $500,000 up on a big deal that's refundable, you got 30 days DD. There's a really good chance at some point shortly thereafter, depending on the next Fed meeting, is that rate's going to change again. And so it's such a moving target right now. I'm not sure exactly what advice to give today as far as how to buy the right asset right now until we can see a little sense of stability of like, okay, well, there's not going to be another 75 basis points hit in the next month and then the following month after that. Where are we really going to end up? And so I would say that the things that we have under contract right now, like we have an asset under contract that it more than likely is probably going to die now. Like the rate literally has changed. At least on that deal, about 1.25%, and it's a $17 million deal. I mean, that changes the economics entirely, unless we can get a retrade. And we're not in the business of retrading, but inevitably, the target moved, and it moved so drastically that the deal is no longer what the deal was when we signed it up. And so I would say, stick to the basic fundamentals. Don't lie to yourself. Don't buy a deal just to say that you buy a deal. I see so much support on Facebook, not necessarily for the full cycles that, the people that took the deals full cycle, but there's so much like, congratulations, great job when someone just either gets a deal under contract or when they just close it. That's just the start. I mean, that maybe you made some money on fees, but gosh, like the hard work is just beginning. Yeah. And not knowing, what this future path of volatility and uncertainty looks like, there's a good chance that GP might work for the next 3 or 4 years and actually not make anything on that deal. Right. They literally might work for free for the next 3 or 4 years. So I would just say, stick to the fundamentals. Make sure that you are absolutely positive. The deal pencils today on in-place NOI. That's first and foremost. Make sure that it pencils today in in-place NOI. If you got to get into a deal today with a bridge loan and you're going to have negative cash flow for the first 2 years while you actually start executing that value add plan, I would second guess it. Again, that's just my opinion, but I'm overly conservative. Maybe you get lucky and you make it work, and because rents continue at double digit increases, that might be the case. But man, there's a lot of what ifs in that scenario, and so that's buying what makes sense today with in-place NOI, I think is the best advice that I can give. Don't lie to yourself. Don't push the model to where you're expecting 5, 7, or maybe double-digit rent increases, because that's happened for the past 2 years. Be uber conservative, stress tested, and then on your exit cap, if your plan is a 3 to 5 year exit, I'd probably not put a 4.5 cap in there. I don't know what to tell you to put in there, but stress it to the cliff. Stress it and find out where it falls off the cliff. And if you think there's a realm of possibility in the next 3 to 4 years that we might be still in that not just interest rate environment, but cap rate environment, we might be there, then second guess it. Know that there's another deal around the corner. There's always another opportunity. I think people get so caught up in the anxiety of, if I don't buy this one, this is the best deal ever. And if I don't buy this one, there won't be another one. And I'm going to, I've worked all this time and I'm going to pass on this deal. And then, there might not be another one around the corner. Just know there's always another deal that will come your way. Just be patient, and the right deal will absolutely come along. And most of the time you'll know when your gut will tell you whether or not you should be doing that deal. And, my gut's never lied to me. I don't know about you, Whitney, but every time I get a little bit of a feeling and I go against what that feeling is, typically it bites me in the rear. Yeah.
It's a good alert measure anyway, right? But you mentioned, or even being willing to walk away from a deal. You said, it changed 1.25%, and I think it's what you said, and it killed the deal. So you all will walk away from this project.
It didn't kill it yet. Yeah, it didn't kill it yet. But we're gonna, we've got a couple more weeks. We've got a few reports we're waiting on, engineering reports and such, and so that when we go back to actually have that conversation, we can kind of lump everything together. There's some CapEx items that are outstanding that I think are going to come back on the engineer report, and so. Yeah, but I'm already mentally prepared. Like I kind of know how that family is that owns the property. They're just an old generational family, and it's interesting. They own literally billions of dollars of assets, and they literally the correlation between what's happening with rates to values of property, like it hasn't registered in their brains. And so I don't think their expectations are any different than what they were 3 months ago, and they haven't adjusted accordingly. And so. I'm not thinking it's going to go in a very positive light. I hope it does. I like to be optimistic about it because I think we are the best buyer, and I don't think there's anyone standing behind us, waiting in line to basically buy something with now a razor thin margin. It's a triple net deal, so there's the value. We cannot do anything different for 5 years, and so you're buying into a spread, and that's it. There's nothing you can do to change that for 5 years to come. And so I don't know if there's anyone waiting in line to take that kind of risk.
Yeah, that's helpful. But I wanted to ask you one more thing on this. You mentioned 2008 was a very different type of recession than now. Let's speak to that a little bit. A lot of people are confused. I think, they didn't go through what you did then. They didn't experience that and have the understanding of what really happened even in 2008. So could you speak to what you mean by, different types of recession?
Yeah. And there's a lot of factors, a lot of different factors, but let's just speak to housing, right? Like back then, we had an excess supply of housing in a number of markets. And I spoke to some of the markets that hit the hardest: California, Phoenix, Arizona, Las Vegas, and then pretty much the entire state of Florida. We had an excess supply of housing. Like we were literally building rooftops for populations that were not there yet. In addition to that, a lot of, the economies in those places weren't as diverse as what they might be today. More specifically, a lot of the major markets in Florida, Tampa, Orlando, Miami, and Jacksonville, they're much more economically diverse as far as employer bases than what they were back then. The same goes with Phoenix. Phoenix is an incredibly dynamic economy, night and day different than what it was, pre-2008. And so that's a big understanding, is that today we literally have a shortage of roughly $4 million or 4 million homes that we need right now, whether it be apartments or homes. We need 4 million residential units right now. And we had such a lull in building coming out of the Great Recession. We weren't building. The population was still growing. Households were still forming. And then we had this slowdown with the pandemic to where there was a little bit of a blip on the radar. And then people wanted to start building again, but then the supply chain completely broke down, and it's been really challenging for us to keep up with even the current demand, let alone make up for the demand that we built up over the last decade or so. And so again, back in 2008, massively excess supply of housing for the population that we had at that present time. Today, complete opposite challenge on our hands. That we have a massive shortage. So as far as residential is concerned, I don't think it's going to be the same type of crash. Again, it's very different. We don't have the teaser loans that were in place back then. People have a lot of equity in their homes. A lot of people locked in historically low interest rates. 3% versus back then it was, if you got a 6.5% mortgage, you were doing great. So and a lot of those mortgages had adjustable dates that came into play as well. And in addition to that, for me personally, one of the big differences, so I'm going to speak to Florida again, because that's where, we had the majority of our portfolio back in 2008. Not only was there an excess supply of homes being built, but what happened is as soon as, ish hit the fan, basically what occurred was a lot of these builders that had, hundreds and hundreds of rooftops, they started renting them out. They started doing whatever they could to pay their monthly nut. And unfortunately, again, not only was the population not coming, but people, a lot of the jobs related to construction, people started moving away. In fact, that's where I don't know if you've ever heard the phrase halfbacks, but basically people were moving out of Florida, going halfway back to the Northeast, ending up in Tennessee or Kentucky or the Carolinas, because there was still some opportunity there where Florida was basically in the toilet. And so we had a major occupancy issue in our portfolio back then, where we were basically fighting against brand new homes that were being rented, and they were offering concessions. We had to offer concessions. When people say that rents ever go down, I'm not going to say that's going to happen this time around. I'm just going to say that it has happened historically. Our rents went down for a period of time. In addition to that, we had to offer a lot of concessions. So we had a massive occupancy issue. And then ultimately what that spun out was, we had negative cash flow at some point in time, and we had loans that were coming due, and it just became a nasty mess that I don't think that most folks in real estate today are in that same position. Again, there's a waiting line of applicants waiting to get into homes in pretty much every market across the country. And so I don't think that we'll go through the same type of challenges. And again, we don't have loans that are basically where, waitresses end up buying 5 homes on, no doc type loan statements and things of that nature. We're not going to have that kind of silliness, but I do think that we're going to have a lot of challenges as far as I think unemployment will probably see a spike in unemployment. We're already seeing a lot of the tech companies. They're having challenges right now. They're laying off by the thousands. I think that companies will struggle. Companies will make layoffs, and inevitably, I think that will trickle down into real estate in one form or fashion or another. But I do think that people that have those low interest rates locked in, I'll just speak to the typical single family homeowner. I think that people want to hold on to that low rate mortgage. And so even if they lose their job, I think a couple of things will happen. Number one, they'll fight tooth and nail to hold on to that valuable asset, which is not necessarily the house, but it's the actual loan on the underlying loan of that house. But now with technology, the Airbnbs of the world, and there's a bunch of other apps where you can rent rooms in your house and things of that nature. That didn't exist back then. Right. And so I think that people will get fairly resourceful, and they'll start renting out rooms in their house. Rent out their garage to someone who wants to park the car. They'll do things, whatever they can, to make that monthly nut. And I don't think that those options weren't necessarily available back during or prior to the Great Recession in 2008. So. I do think that we're going to be in for some bumpy roads. Again, I think just sticking to the basic fundamentals, buy things that only cash flow today. Don't be speculative in nature. Stress test your underwriting model to the nth degree. Find out where that cliff is, and then don't just take your own perspective. Get outsiders' perspective as well. Talk to others that have been there and done that. Talk to others in the marketplace and try to get their temperature of what they anticipate is going to happen, and then make a collective, educated decision at that point in time. And just again, know that. Inevitably, there will be opportunity around the corner. This isn't going to be, hey, if I don't buy now, we'll never be able to buy again. And I promise you, opportunity will come, and just be prepared for it. And lastly, I think the last thing I want to mention that one piece of advice that was given to me prior to 2008, which I didn't take to, but I have taken to since then. I wish I would have made the decision back then. Is that you never lose by taking some chips off the table. I know that real estate's a phenomenal hedge to inflation. It is. There's really not one much better than real estate. But also a lot of folks have they have a ridiculous amount of equity right now in some of their properties. And I know you might not have another place to put it right away. Your dollar might get inflated away a little bit, but it truly never hurts to have a bucket of cash sitting on the sidelines. And so you never really lose in the grand scheme of things. You just truly don't lose by taking some of your chips off the table. So I'll leave it with that. And that's one thing that we've done over the last 10 years, probably a little differently. We definitely are long-term holders, but we have strategically sold a number of assets, and it's positioned us, with a really, really strong balance sheet, a personal balance sheet, to where I'll be able to weather any storm that comes my way. And I'll also be prepared for any opportunity that could ultimately come out of this challenging time ahead.
Yeah, I love that. You'll be ready to weather any storm, but also be ready for the opportunity as well. Stress test it to death, and just some great advice. I just appreciate from your experience, Kevin, just being real about what's happening and about the cash, having cash on hand as well. I've heard somebody say the other day, no cash, you crash. So you can't be so focused on the inflation that you're worried about losing the value of the dollar.
Absolutely.
You don't have a reserve, right?
Yeah, that's it. And same thing on a property level too. On a property level, like make sure that you, even if it means that you have to, like during the pandemic, we stopped distributions for a period of time until we realized that people were going to pay their rent, right? But we stopped distributions and we stockpiled cash for I think it was about 4 months before we resumed distributions. And I think if you don't have 6 months of operating capital or whatever that means to your particular property level business, start thinking about that, getting your financial house in order and making it bulletproof and being able to withstand. Maybe it takes you a little bit longer to turn a unit. I know you got people waiting in line to get into one of your rentals, but the labor shortage is real as well. Like finding the right people, you get someone to trash your unit, and it takes you actually 3 months to turn that unit when it should have taken you maybe 3 weeks in a normal situation, but you can't get the right talent in there to get it turned and get it ready again. Just make sure you got that cash at hand to actually pay the debt service and actually float you until you get another paying renter in there. So again, just be financially capable and ready to act in the event that you find yourself in a challenging situation.
Thank you for being with us again today. I hope that you have learned a lot from the show. Don't forget to like and subscribe. I hope you're telling your friends about the Real Estate Syndication Show and how they can also build wealth in real estate. You can also go to lifebridgecapital.com and start investing today.